Hello friends and welcome. Today we are going to talk price to EBITDAX ratio analysis, 6 essential factors for investors. Before we jump into the video, make sure you like the video and subscribe to our channel for more educational videos. Now, let's get started. The price to earnings before interest, taxes, depreciation, amortization, and exploration expenses P to EBITDAX ratio is crucial for investors evaluating a company's valuation, incorporating exploration expenses. Here are 6 essential factors. Definition of P to EBITDAX ratio. P to EBITDAX ratio compares a company's market price per share to its earnings before interest, taxes, depreciation, amortization, and exploration expenses per share. Incorporating exploration expenses, this accounts for costs associated with discovering new reserves, providing a more accurate reflection of operational performance. Cash earnings measurement. EBITDAX measures cash earnings from core operations, excluding exploration expenses, offering insights into operational profitability. Industry comparison. Comparing P to EBITDAX with peers helps assess valuation relative to industry norms, identifying investment opportunities. Relationship with valuation. P to EBITDAX offers insights into valuation relative to earnings before exploration expenses, aiding in determining undervaluation or overvaluation. Risk assessment. Considering the company's risk profile is crucial, particularly in exploration-heavy industries. Conclusion. Analyzing the P to EBITDAX ratio involves understanding its definition, incorporation of exploration expenses, cash earnings measurement, industry comparison, valuation relationship, and risk assessment. These factors empower investors to make informed decisions regarding a company's valuation and investment potential. I hope that you like the video and do follow our channel for more professional and business tips and other interesting videos. Thank you and goodbye.